In stock investing, it's seldom that you get to have your cake and eat it too. In the case of Hewlett Packard, it delivers great appreciation. The stock is up more than 38% in the last month, and it delivers a really nice dividend. So we could have nice income while we see a stock really appreciate. Hewlett Packard is a storied company. It's one of the original technology companies headquartered in the Silicon Valley. They were innovators a long time ago on a variety of devices, PCs, and printers. More recently, their PC business had really hit a wall. Revenue had gone down. But more recently, they've shown that PC sales have begun to grow, and their forecast is really promising for PC sales to really go up. All that's good news for this legendary company, and it's great to be a value investor in Hewlett Packard. I'd like to take a look at the company, reassess my investing criteria, and decide whether I should buy more shares, hold my shares, or sell any shares of Hewlett Packard. Before I jump into my analysis and my conclusions, let me remind you that I'm an individual value investor. I'm just sharing my experience with you, and I hope you find it interesting. I'm not recommending that you buy Hewlett Packard stock. I'm not recommending you sell it, and I'm not providing any financial advice. Now, let's take a close look at Hewlett Packard. Hewlett Packard has a market cap of $38 billion. These days, that's either a small cap or a mid cap, believe it or not, because companies are valued so much. The company drives $53 billion of revenue each year, and they have a dividend paying 2.85%. They can afford that dividend with no problem. They have a PE ratio at 11.42, which is really nice. And analysts say this is a good buy opportunity, but I don't think their estimates have kept up with the stock price because they're saying that the stock is overpriced by 12%. Might be because today alone, the stock is up almost 18%. The company, again, for the past year, hasn't been doing great. They've seen revenue really go down. I think part of it is everybody has a PC they need, and their printer business has really struggled for good reason. I don't think a lot of people are printing, but their PC business is really growing, especially on the commercial side. And now they have a really nice forecast looking at the future where the company will grow their PC sales. The company's really solid balance sheet. The company has a very good cash balance of $3.2 billion, and they don't have a whole lot of debt. Total debt's $9.4 billion. They can pay off their debt in less than 3 years if they use their EBITDA. Their debt to EBITDA is less than 3, which is one of the qualifiers I have as I make a decision on a stock. Their cash flow is very good. This company has consistently delivered high free cash flow to investors. The most recent year, they had $3 billion of free cash flow, which was very good. I use free cash flow in my valuation, and I will be doing so. The company had earnings. Let's take a look at what the company had to say. HP delivered an earnings per share that was in line with what they set as an expectation. They also had free cash flow in line with expectations. They also are guiding up on the second quarter or the next quarter of earnings, which is good. A lot of companies have been guiding down recently, and they really get punished by the street. It's good to see a company really come in and say, hey, our business is expanding and we're more optimistic. That's the main reason behind the rally today in Hewlett Packard. Overall, they've guided that they're going to do a fair amount of free cash flow in 2024, and I'm using their guided cash flow rate as well as my own estimations of a little more than $3.1 billion of free cash flow in the current year. That's a very good cash flow amount. I'll be using that in my evaluation. So overall, I really like the Hewlett Packard management team. They're really guiding the company in the right direction for the business. They communicate very well with stockholders. Not too long ago, this stock really crashed after an earnings call because the management team was honest with investors. They kind of took some medicine at that time, guiding down some numbers. It's good to see that management team really bounce back and have a real positive earnings report. I also use earnings per share in my valuation, and earnings per share for HP is really good. It's expected they're going to do $3.46 per share, and it's going to grow this year, next year, and in 2026 by a modest amount. So that's good growth rate, and I'll be using that in my valuation. Overall, good balance sheet, good income statement, good statement of cash flow, good earnings per share. It's just a really good company. I'm going to value Hewlett Packard using their free cash flows as well as their earnings per share forecast. Looking at free cash flows first, I expect the company is going to produce $3.1 billion of free cash flow in the current year. So that's going to be my starting point of their cash forecast. I'm going to grow the first couple of years very modestly by 2% and long-term growth by 4%. That's a very conservative forecast, but I'd like to be conservative because we are dealing with PC sales. And I'm going to discount all those cash flows by 9% to get to an intrinsic value of $55.9 billion. I'm going to add the cash and take away debt to get to an equity value of $48.8 billion. The current market cap is $35.4 billion. So there's an overall 29% discount when we value the cash flows of this company, even after the company's stock has really run up 18%. When I look at earnings per share, I'm going to use an earnings per share expectation of $3.42 per share. I'm going to use a price earnings of 12 and a growth rate of 3%, which gets me to a value per share of $42.27. So overall, compared to the current stock price, there's about a 9% discount on the stock if we use earnings per share as the valuation method. I combine the two and I put more weight in the free cash flow method, and I get to a 22% discount on Hewlett Packard stock. I evaluate each company that I own every quarter, and I go through a process of deciding whether I should buy more shares, hold, or sell my shares in a stock. In Hewlett Packard, I've seen a stock really appreciate over the last 30 days, which has been really fun. But should I buy more shares now? Should I hold or sell my shares, or sell even a portion of my shares? Let me make that decision with you. First, the first part that I really look at is the company. Do I really believe in the company? Do I like their management team? Do I like their business? Do I believe in their industry? And it's yes. I like the company, great brand. They have good operations, just a really good culture at the company. And I really like their management team. So yes, I want to be a part owner in this business. The balance sheet. Do we have a quality balance sheet that has less than 3 times EBITDA, a debt less than 3 times EBITDA? Do we have a quality balance sheet with Hewlett Packard? And the answer is yes. So we have 2 yeses. Now discount. Do we have a good discount on Hewlett Packard? And the answer is yes, but we have to deal with reality. The stock's really run up in the last 30 days. So it's uncomfortable for me to buy right now. I would rather buy on a dip. I expect that the market is overpriced and I'm expecting a correction this year. I might wait until this price really settles down a bit before I buy more shares in this excellent company. Thank you for watching my video on Hewlett Packard. I hope you found it interesting. Please leave comments on this company. Let me know what you think. And again, I appreciate you watching.